Hello, everyone. Welcome to today's session. Let's get underway here. Market conditions bearish in this bull market currently, and we'll spend some time going over that pattern and some of the weakness that's happening here. In the shorter term, we're seeing a momentum sliding all the way down to this extreme range, and this starts to turn green right here. When we start to turn green, we'll look at some other charts here. That means that momentum has gone too far, too fast in one direction or the other. It doesn't necessarily mean that the trend is over, but it means that it could be starting to get to an area where we start to get a possibility for a bounce. In this case, this breadth indicator sitting, right about the middle, and sentiment sitting towards the upper end of that complacency range. So when we see that VIX, this sentiment number in this upper complacency range, that's still a possibility for a bounce, for dip buying in a bull market, meaning that this let's look at this chart at the top right here, meaning that when we get that, this obviously has been our uptrend. This was the move from, this is a 1-year chart. So from last year, we had the October low, and then we've had this big, nice rally. We haven't retraced any of that rally to this point. So this part here, now just working on a retracement, more than likely, that's going to be the scenario, is an extreme move down, and then one more push, or maybe, 2 or 3 or more pushes to the upside. The other possibility is that we kind of rally up and that we retrace a little bit deeper move, maybe all the way back down to this. So we're sitting right here at this level, and it's an area that it could bounce. If we look at S&P 500 right here, we've got sitting right at a support area. Well, not quite yet, but in terms of price activity, this is a significant support area, because you've got this area, you've got this area, and now we're sitting right in that. Even if we were to go up just a little bit higher, kind of this entire zone right here has had some historical price activity over on this side of things. So it's going to react, or could react, should react, get as far as a support area. Now, that being said, we've got sentiment moving all the way off to the side here, but it is, or not sentiment, but the we've had a decent retracement. Yesterday was a big bar move lower. Now that there, and I'm going to talk about both the bullish and the bearish scenarios right here. The bearish scenario is when we have, well, let's actually jump out to sentiment here, because we also have this starting to work down towards the extreme level. Not quite yet, but it's getting there. So we're already at an area where we could get a bounce. This was last fall. This was October of last year, after that big nasty sell-off that we had, or the entire, I guess it wasn't too nasty, but it was a downward trend, this entire market move here. Now we're entering that low, okay? And that could be that we are right here still. And maybe we touch this, and then we rally up, and then we continue the overall downtrend lower, okay? Either way, whether this is a new downtrend or not, we're getting to an area where we could see a bounce, and then that will have to prove itself. That bounce is going to have to prove itself back to the upside. We also have buy-sell ratio, which is really extreme right here. We're down, it's not really, it's 0.15. It can get a lot lower than this, but that is a big move, especially where we've been talking about this breadth area here. This much of the buy-sell ratio has not reacted. This was the bottom of that new trend right here. This is that October low. This started to move higher, and then ultimately we did get that new bull market. But then once we got to the upper range of this bull market, all year long, it's been a relatively tight range. Now we're breaking out of that. This is bearish. This is the number of sells in the database, which is currently 3,070 to 458 buys. This doesn't include the holds in there as well, so there's probably a bunch, 3,000 or 4,000 in that hold range as well. And so when you have 3,000 stocks to the downside, well, a lot of those stocks are in pullback opportunities. So that's why I said it'd be interesting to see if we're going to get close to this first move. If we rally up and then we get this first move back down. Like I say, if you look back historically, most of the time when you're getting one of these big bearish moves, that's not the end. We don't immediately cross and head back higher. We typically get longer, drawn out downtrend. So I think this is the early stages of whatever this downtrend is starting to unfold. is this is what a beginning looks and feels like. Same here when you're looking at the markets and the S&P 500, and you've got a big red bar, and it's sitting here like this. We were to look back and say, you know, where do we have other big red bars happening in the last couple of years when they go from hold, that hold starts to give you that warning. Okay, and here you get that hold, that warning, but it never quite reversed. Here it did. Here you got the red, it started to move lower, and then we bounced back up, attempted a rally, and then it rolled. We got the yellow right here, and then it just rolled back over again with more red. So we're sitting right here now, this early red stages on S&P 500 were extreme to the downside, meaning it's gone from here to here really quickly and could bounce back up into this sell zone. It could bounce back up, still in a downtrend, but are having a rally higher. And then this becomes our playground. Basically, we go extreme, we rally back up into the sell zone, we go extreme, maybe we go all the way up. Okay, that's dealing with a downtrend now versus focusing on the uptrend, which we've been talking about for so long, really this entire rally. So this stage right here, it could be, you know, it could be a support area, and we certainly could see more upside from here. That isn't out of the question, but it's now at an area where we've got to really shift our bias at least 50% or more towards more downside. Okay, and now what that means when you're allocating and you're managing your funds is you've got to decide what that means for you, because it's going to have volatility. Now, if you're a shorter term trader, obviously it's easier to maneuver a portfolio. If you're a longer term investor, trader, this just is an allocation type of adjustment to say, you know, we've gone from this low in November and October of last year all the way to this high, and there's the possibility of retracing 50% of that move all the way back to here is certainly in play as well. And especially if inflation stays high and interest rates stay high, and then if we start to see some concerns in corporate earnings, we saw, you know, a bunch of layoffs with Tesla. And, you know, if you start to see some of those things with companies where they're cutting costs, laying off is a cost cutting maneuver. And what that means is oftentimes cash flow is starting to hurt. And so the fastest way to save cash is to lay people off, because you instantly, a lot of these big companies instantly this week will save millions of dollars that they won't have to spend out on employees. Now that sounds harsh, but that's the reality of the way companies think. Is employees are an expense for the most part, and the fastest way to cut expenses are to cut employees. So if you start to see that, then companies are slowing down and they're starting to hurt on the cash flow side. That means that front end of revenue, the revenue stream, is consumers are slowing down. So if we start to see a theme to that, obviously the market is going to respond, and we are responding to the market for the most part. Is essentially the way that we're managing risk and looking for opportunities. Is what is the overall trend starting to unfold. Now, this is, you know, if we look at this perspective and then we go back to the market trend, to the direction alerts, and we look at this 20-year perspective here, okay, it looks, yes, we have, you know, every single time, you know, you just like the Warren Buffett's, like it says, don't bet against the U.S. economy, you know, and I agree with that. I think ultimately stocks are designed to go higher, but if you look at the trend and where we've been, and even pulling back from this October low, we're starting to get this parabolic feel. Now, a retracement, let me delete some of these lines. A retracement back to this high, this 480 range on SPY, could retrace and come back something like this. Now, if we get to this area, this could be a really interesting scenario, because number one, in terms of Elliott wave, if you ever studied Elliott wave analysis, Elliott wave says that price patterns go 1, 2, 3, 4, 5, ABC. 1, 2, 3, 4, 5, ABC. Okay, so they uptrend and then they counter trend, and so we could have, you know, this potentially and oftentimes wave fives happen after a breakout. So we could get 1, 2, 3, 4, 5. This is probably the most bullish scenario with shorter term bearishness that could be significant back to this support here around that 480. I'll go into that other chart and we'll look at that. But the other scenario is that this entire move is a wave 5 completion, and that this is a major market top, and that we could potentially retrace all the way back down. But that's the most bearish, I would say, to the other side of things, is that this, the most bearish doomsday scenario is that we get a 50% retracement of the last 20 years. Okay, and where does that take us? It takes us back to COVID highs or even those market lows. That would hurt, and that'd be painful. And that if we get a recession and we run into a lot of these situations that are being talked about right now. In fact, I just did an update on the bond yield curve. It's out on YouTube to talk about this particular situation right now, where we're dealing with this inverted yield curve. Okay, and go watch that video, because it talks about that the inverted yield curve, this 2-year treasury and this 10-year treasury. Okay, this is paying more money than this. This is paying a 3-month yield is 5.3 versus a 30-year at, let me mouse over that, a 30-year, which is sitting at 4.6. So that's got to correct itself. Okay, and when we talk about the bond yield curve, that's a healthy yield curve from low to high. This is a healthy yield curve from low to high. But look where they're happening. This is the .com 99 2000. Yes, this bonds were high for 3 or 4 or 5 years and almost inverted or flat for that long. So that yield curve can stay like that for a really long time. So it may, the markets may also just blow it off, but it typically does slow the economy enough to start to get recession at some point. And that's what the Fed's wanting. That's what they need to have happen, is they've got to break a whole bunch of stuff in order to slow the economy, in order to slow inflation. It's a painful process, and they want high unemployment or higher unemployment. So if you're getting good employment, you're getting all these numbers that are showing that prices are continuing to move higher, then that's a problem. Now, this is the other problem that is with that scenario for the Fed, in my opinion, is that commodities, if you look at, I've got the 2-year time frame. Let me go back down. Now that 1 year is pretty good. Here's gold. Okay, gold is a commodity. Inflation moving higher. Do you think the inflation rate on gold is slowing down? I don't think so. What about oil? Inflation. Okay, it's moving higher. That's all inflation is inflation means that something, in this case, oil went from $65 to $85 a barrel. Okay, is the Fed helping in inflation with USO? Doesn't look like it. Okay, so some of those things, and food prices and housing and the stock market, okay, all of those things are still going up. That has to change in order for interest rates to come down. So the Fed's got to keep rates high. They got to break a whole bunch of shit, and they've got to and then they've got to crash the markets, essentially, for things to get back to a non-inflationary state. It's going to be a whole lot more painful than it's felt in the last year, in my opinion. It's got to be a little bit more ugly than this. So since we're not there yet, okay, how do we position ourselves? We've got to position ourselves based on our time frame for needing the money. Anytime you're trading in equities, it's a timing game, okay, in terms of length of time, and then it's an allocation game. How much risk am I taking, and in what stocks or in what vehicle? Am I using a mutual fund or a ETF? Am I using the stock, or am I just sitting in cash? Now, cash is not a bad option. Why? Because what is cash paying? That's cash. Cash is paying 5.5% right now, and that's not going to change. That's not going to go down anytime soon. So in terms of a prudent allocation, cash is completely fine and probably really good right now, because for the next year or two, it's going to be above 5%. And so if you want, something that's not going to move at all, a large portion, if that's money that you need in the next 3 to 5 years, and you cannot afford any volatility at all, cash is a great spot for that money. Okay, and now cash can mean anything from your money market account and your brokerage to your a 1-year CD at the credit union, or whatever that is. It's relatively liquid. Cash, pure liquidity is, you stick it in your savings account or your money market account, and then you have access to that today or tomorrow. Something a little bit longer term, obviously, you might get a little bit higher rate on it, but it might tie it up for 6 to 8 months or a year, something like that. Okay, so those are options in the shorter term if you're looking to maneuver or at least rebalance some of the risk out of equities into other assets. And it makes sense to do that because stocks, when you look at a chart like this, it makes it look easy, right? Oh, just buy stocks. They just always go up. Well, yeah, until you ride this out and you ride this and you deal with this and you have COVID and then you get monetary this and that. Now you got inflation and it's like, it's a circus, right? It really is. But this is also a good example of why kind of staying the course and making sure that you're allocated properly for the longer term as well. And in the short term, not hurting yourself, not doing any harm, but continuing to put that money away and making sure it's in a place that you can deal with the volatility or not. Okay, that is really asset allocation rule number one is the length of time that you need and that you can afford to have volatility, because we may have another COVID, we may have another subprime, we may have another .com bust. Okay, we may have another monetary easing cycle. We may have whatever is coming, okay, is going to be something along those lines. It could be nothing. It could be war. It could be earthquakes. It could be, I don't know that we really want to spend a ton of time on what all of the bad things that could happen in the world. We just want to understand that they could, and that will affect money and it'll affect asset prices and stocks particularly. Okay. Let's jump back to it's kind of a macroeconomic perspective on things and bonds and interest rates. You're going to get different conversations about bonds and interest rates, but and follow the Fed. That's an old Wall Street adage, is just follow the Fed, and that typically works because the Fed ultimately can control. They've proven that they can control ebbs and flows in the economy. It's a boom and a bust cycle. It's painful, and they're usually bad at it, but and too slow to do the right thing. But typically they know that, and we all know that. It's just the game they play. So we got to be willing and able to ride out overshoots in both directions, to the upside and the downside. Let's jump over I wanted to go over a couple of other things on this sectors page. Sectors, here's another look at sectors. When we start to see this, and I like to go through multiple breadth scenarios so that we can kind of get a good idea of what the market breadth is. So in this case, when we're talking about breadth, we're talking about each of these different areas of the economy, basic materials, and they're often referred to as sectors. Okay, sectors, you've got energy, you've got utilities, you've got healthcare, industrials, real estate, technology, financials, consumer goods, transportation, telecom. Okay, these are all kind of the core areas of the economy, and they're broken down. So when we start to see this, then we know that across the board, this is a sell-off that's happening across the board. When we see these indices, the index scan, we look at the buy-sell ratio here. Okay, the number of sells here versus the number of buys here. Russell 3000, you've got 1,000 down, you've got 100 up. Okay, you've got all of these already. This is why it's actually kind of interesting. This is what you see. You see these numbers at major market bottoms, typically. Okay, so either we're about to collapse, and all of these sells are happening now because the rest are going to follow, and all of these are about to completely get pummeled, or the market is overreacted and we're going to get a bounce. Now, there's probably some truth to both of those statements, in that we're going to get a bounce. It's probably going to happen soon because we're getting so oversold right here, or these are just leading the crowd and we're just about to see things unglued. I don't know which is which, but the market will let us know. We're going to need to see a confirmation day. We're going to need to see at least 1 or 2 days of stability, and then start to analyze some of these numbers as well. But that buy-sell ratio popped pretty quickly, and that also is pretty bearish for the market as a whole right here. So no reason to rush out and get crazy buying stuff aggressively. It's about right now, and probably for this next year, is going to be about capital preservation with a slight edge of growth right here. And, I think we're going to still have lots of opportunities. It's going to be a lot of stock picking, looking for some of those diamonds in the rough, and see if we can pick some of those out using the muscle scans. The muscle scan and the new buy list, the advantage of that is that these are always stocks that are moving higher. So even yesterday, so you have BRFS, which is a Brazilian food company, and it was up 8% yesterday and still continuing to work. And it's that exact pattern that we want to see. It's an exact uptrend where we've got a stock, it's rallied higher on our 6-month time frame. We've got our Fibonacci tool that snapped to that swing low and this swing high. We've got significant support here that is also corresponding to support or resistance historically, a bounce, a double bounce, and then a good solid bar. And let's see if we had some volume on that. I think we had an increase in volume on that bar yesterday. So an increase in volume on that day as well. Does that mean that it will go higher? No, but it means that the market is continually pushing into this stock as it's moving higher, and the market's collapsing, the market's tanking, and stocks are continuing. At least this stock is starting to move. We're not going to get them all, but there's going to be some that we can look and say, hey, what do these guys do? They deliver food, or they produce food. It's a consumer produced food stock. In fact, again, out on YouTube, I did a video on this one this morning also, and go check those out. It's a really interesting company and stock as well. Muscle stock. So that's your place to look. You can also look at ETFs, the muscle ETF group, and say which of these sectors are moving, and do I want to try and take advantage of that movement through an ETF or an inverse ETF instead of me trying to pick the stock out of the group. Okay, so the way to be able to do that and avoid trying to pick a stock and get the right stock is to use an ETF. So for example, and we've been talked about these like gold. Now, if you're going to trade a commodity like gold, why not go 2x? Why not go 3x? Okay, leveraged, because gold is a commodity that it's just supply demand driven. Okay, you're not going to get a big huge earnings report on gold or anything like that when it comes to it producing anything. It's just a commodity. So these are ways to be able to leverage against some of those price moves and be able to trade around some of those commodities as well. And ETFs are easy to trade, and you don't have to trade them through futures or it's just an easy instrument to be able to trade relatively shorter term or to hedge. I don't think they're very good long term investments, because especially the leveraged ones, because they have to rebalance them so often, and the price ends up getting a little bit skewampus, or can be. It can add additional fees and expenses and different things like that as they're rebalancing, and it can change the overall percentage longer term over time, over the course of a shorter term, 2-3 weeks, a month, even something like that. You're going to be fine being able to trade and hold an ETF like that. Now, the inverse and the leveraged ETFs, again, they're good ways to be able to take advantage of bearish trends. SPXU, let's look at that one, because it should be the exact opposite of the S&P 500. Let me refresh here. Got some splits on these. We'll have to get those fixed too. All right, I'm not going to be able to talk about those, which is fine. We're going to finish here in just a minute anyway. So just to summarize, we're bearish in a bull market, meaning that we're in a pullback inside of this longer uptrend. Okay, so we're in an uptrend. This is a bull market, and we're bearish in a bull market. We're trading lower, and that can sometimes turn into more downside. So we want to be aware that these conditions are moving lower. They may shift and they may head back up again, but until then, we want to be able to be positioned to handle any kind of volatility, any potential downside risk. And keep an eye on this buy-sell ratio, keep an eye on the sentiment, keep an eye on some of these indicators that are talking about the overall market breadth and perspective as well. They're going to be telling right here with some market tops and bottoms and acceleration. If we get some acceleration to the downside, It's probably going to be based on geopolitical risk, oil, interest rates, Fed, and those are kind of the hot points that are out there right now. So that'll do it for today's update. Everyone have a fantastic day, and we'll see you next time.